Hello and welcome to Kitco Mining's Digging Deep with me, Paul Harris, here at the Vancouver Resource Investment Conference in Vancouver in Canada. We had a bit of a hiatus over the holiday period, but we are back and ready to dig deep and unpack the mining and exploration news again. And joining me today to do so is Nicole Adshead-Bell, Director at Cupel Advisory. Nicole, welcome back to Kitco.
Thank you very much for having me, and welcome to my hometown, Vancouver.
Pleasure to be here. We've had a couple of sunny days, so I feel very privileged and lucky there. I want to start with something that you perhaps know very little about, so I apologise, that's a little bit unfair. But I want to start with the Future Minerals Forum in Saudi Arabia last week, where we were filming. There were over 22,000 delegates there, 90 ministerial delegations from around the world, including the leaders of all the world's big mining houses. It was a remarkable event. It was a very high level. I interviewed Bandar Al-Khurayev, Minister of Industry and Mineral Resources, and Khalid Al-Madafi, the Vice Minister of Mining Affairs of the Kingdom of Saudi Arabia. And it's very clear they want to invest, they want to partner, they want to fill the space of the politically non-aligned friend of the mining world that perhaps you could argue Canada occupied 10 or 15 years ago. It was truly amazing. What do you think is changing in the mining world? The pendulum seems to be moving towards Saudi Arabia, the Middle East, the funding, less moving away from Canada. Is that a fair observation?
It's a very fair observation. If you look at the junior sector, despite all-time high prices in gold and obviously strong prices in other commodities and I think a very positive outlook, it's still incredibly difficult to raise money if you're a small company. So capital is available for a select few, and the industry is trying to understand or navigate this uncertain capital world. And I've heard very good things actually about the Future Minerals Forum in Saudi Arabia. So I'm curious, what was the feedback from the junior investing community? Did they get a sense that people will often talk about wanting to put money to work, but then that wallet to company action still needs to occur?
You're asking me a question. I'm quite unprepared for this. Well, I did speak with a lot of juniors there, and they said they were there looking for money. They said there's money. They had a lot of meetings with different kinds of investors. One of the key things they said to me was people there have a different time horizon on investors. They certainly get the sense that the meetings they had, people aren't looking to invest just to get a flip trade the next quarter. They're looking at a 3, 4, 5 year timeline, depending on what their business plan is and the time it takes to develop the business plan. The investors they met were sort of in alignment with those time horizons to achieve and realize the business plan. So obviously very different to perhaps a North American time horizon.
Well, I think sticky money, whether you're a junior resource company or you're a fund that invests in the resource sector, sticky money is the best kind of money to have. And so investors that have a 3 to 5 year time horizon, we live in this very cyclical world. We know that the duration from discovery to production is long, plus 17 years and getting longer. So if there is a pool of capital out there that's willing to take punts in a high-risk sector and is willing to take a long-term and patient view, I would say that's quite unique. And also, that's fairly agnostic. Your point about Canada. I mean, Canada, the Canadian government has sent a very, very clear message, for example, to China, that you're not welcome within our critical mineral list. And that has been a continuous and long-term, and I would argue sticky supply of money for many companies in the resource sector. And so having access to varied and sticky money that's a positive.
Another aspect companies were talking about was the possibility, their curiosity. They're looking at the possibility of exploring in Saudi Arabia. And they said it's very refreshing engaging with the government that actually wants it to happen and is actually helping achieve things, take down barriers, achieve permitting, reducing the timeline of getting from A to B. So a lot of people commented it's quite refreshing engaging with governments like that rather than perhaps what their prior experience has been in Canada, South America or elsewhere.
I mean, democracies at the end of the day, they're messy, they're layers of bureaucracy, and it's getting more and more difficult to permit. And so in certain jurisdictions where decisions can be made quickly and then enforced, again, that's a positive. And there are, as you said, there's a number of companies that are exploring in the country, and it's got a potential for a pretty material endowment of gold and copper. And it's very, very underexplored as a jurisdiction.
I met with the people at one of the world's leading geophysics companies, and they said that their biggest contract is in Saudi Arabia. It's tens of millions of dollars. They're doing 1 million line kilometers of geophysics to build up that base of information from which explorers can use and access and do their thing.
The government is funding that.
Correct.
That shows a long-term commitment. That's good.
Absolutely. Now, my interviews with the Saudi ministers, plus people like Newmont, VRIC Gold, Codelco, and others will be available on Kitco's YouTube channel very soon, so hit that subscribe button. Now, I interviewed Tom Palmer, CEO of Newmont, the world's biggest gold company, last week, and he told me some very interesting things. He said he expects to see Newmont return to lowest quartile on the cost curve this year. It's had quite mediocre performance, middle of the road performance for the past couple of years. So how important is it for Newmont, for the world's leading gold producer, to have leading sector costs?
In a rising gold price environment, I don't think it's important at all. The companies that perform the best in a rising commodity price environment are those that are most highly leveraged. That means those companies that have more debt on the balance sheet and have a higher cost profile. And so investors flock and are concerned about cost structure and capital deployment when a commodity price starts to decline. So I understand the long-term desire to do that, but I don't think you'll necessarily see a big lift in your share price if the gold price continues its positive trajectory just because you have a lower cost profile.
Well, can we look at that from a different lens or in a different way? Newmont's the biggest gold producer. The gold sector wants to attract more generalists. If you're a generalist investor, you look at the best gold company, you see it's got mediocre performance, you think, I can just forget the whole sector. So from that point of view, is it important for Newmont to really improve on its cost position, really expand its margins?
It's a very interesting question. Again, generalists will be attracted to the sector in a rising price environment. They will not care if gold price is going down. Generalist investors, I would argue they don't do a lot of work. They'll either buy the ETFs or they'll buy the top three names. For them, liquidity is the most paramount important thing, and they'll be looking at talk to the underlying commodity price. So again, I'm not sure that institutional investors will be so focused on those that have the most financial discipline. Again, financial discipline is incredibly important when you're in a weakening commodity price environment. At the end of the day, you're looking for share price performance, and share price performance is normally a result of leverage, leverage on the positive side and leverage on the downside.
Okay. Now, Newmont has raised more than $3.9 billion through its divestment program, which is almost completed. Apparently, dozens of companies were interested in bidding for those assets. Now that Newmont has sold those assets, will the companies that missed out be looking to buy other companies in the open market? Will that charge a new M&A cycle?
Absolutely. I think we're in the part of the commodity cycle where investors are starting to ask for growth. In the downturn, everybody was concerned about capital discipline, didn't want to see any R&D, so no exploration dollars spent. And now in a rising price environment, the question that most investors will be asking is, where is your growth? And will be willing to pay for growth. And in our sector, what you tend to see is these themes of behavior that sweep through the companies. And so once one company does some M&A, what tends to happen is boards and management go, well, that company did it, so we should be doing it. And so, yes, when you have an event like this, where a major that's divesting itself, those assets are gone, then companies start to feel like they're missing out. And there's very, very few single asset gold developers, advanced gold developers, or producing names. And so I think we're moving to the part of the cycle where there's a very strong M&A thematic that'll be running through it. Unfortunately, a lot of M&A is commonly negative for the acquirer, very, very good for the seller. So, and I would argue that the developers are still very, very undervalued on a relative basis. They have not received the love that the producers and the more near-term developers have. So I think M&A will absolutely be a dominant investing theme over the next year.
Well, let's run with that. A year ago, we saw BHP try for and fail to unite with Anglo American. Now the talk is of Glencore and Rio Tinto possibly getting together. What is going on there, and what is potentially attractive about this matchup?
Again, I would say that Rio and Glencore started to have conversations probably after the failed BHP and Anglo. So in our industry, you see these themes of behaviour. Once one company does something, its peers tend to go, well, we should be doing that as well. So it's fascinating. Obviously, there's a lot of public discussion, two very, very different companies, but it would create a behemoth in terms of copper production. But the problem is once you, and the market and the companies always focus on synergies, but it would be my observation that a bigger a company gets, the more it becomes about process and not productivity. And so I think often these mythical synergies that are discussed and never realised, because you just end up with layers upon layers upon layers of bureaucracy, rather than trying to retain an element of leanness and rapid decision making.
Now, Nicole, you serve on the board of a couple of public companies. And I want to reflect back on BHP's bid for Anglo American. BHP has 12 people on its board. It's quite a diverse board of directors, yet only 3 have experience running mining companies. Brian Henry, the current CEO, Gary Goldberg, and Don Lindsay. With the increasing cost and risk of investments in the space, should a mining company board have more mining experience on it to debate things like how much to bid for Anglo American, for example?
Absolutely. I won't name names, but if you go and look at, say, the top 10 companies across the commodity space, so the top, say, 4 gold companies, the diversifieds, I find it absolutely shocking how little mining representation there is on the board. And that's not just technical people. There's just, you can be not a mining engineer or not a geologist or a metallurgist, but have worked your whole entire career in mining in a different aspect of the business. There is not just lack of technical skill sets on the boards, there is a lack of mining industry skill sets. And I suppose my personal take is you had this theme over the last 10 years, it started in 2015, where it was paramount to have diversity. And I think in the effort to rush towards meeting those diversity criteria, benchmarks, boards haven't necessarily been as strategic as I think they should be in ensuring that they have a core of mining industry competency. And I would argue some of the behaviour that we've seen and some of the decisions some of these companies have made is because of a fundamental lack of detailed understanding on a board. And in my experience, as a single director, you can't implement or enact change. So if you don't have a core competency, I'm not entirely sure how you can have robust discussions. If you don't even understand the questions to ask, how do you understand the answers? And so there needs to be, I think, a healthy communication between boards and management teams and healthy friction. I actually think it's a material concern.
Absolutely. Now, another material concern that's been in the news very recently in West Africa is Mali. A lot's been going on there over the end of the year period. The military government is seeking greater rent from the mining sector and is using very aggressive tactics to try and achieve that, leading VRIC Gold to suspend operations at its Loulo-Gounkoto operation last week after the government seized an estimated $245 million in gold. When I spoke with Mark Bristow last week, he said he didn't really want to discuss the ins and outs of what's going on there, which I fully appreciated, but he did say how that situation is resolved could affect the investability of Africa in general, and investor approach and attitudes towards Africa. Beyond the hubris, could there be contagion to other countries and also to investor attitudes to that continent?
Absolutely. I think often countries in a continent get lumped together, and obviously every country and every jurisdiction has a different political risk profile. But for instance, I'm hearing a lot of negative rhetoric about Burkina, and the last time I was in Burkina it was in 2015, and it was really before the incursions and I suppose of increase in terrorist activity and the fluctuations in political stability. So I think what you're seeing at the moment, and this is where these governments just do not understand, if you bite the hand that feeds you, if you rip it off, that might help you in the short term, but nobody is putting any investing dollars into Mali now. It's basically uninvestable. And you're starting to see that same perception happen with countries like Burkina. So there is contagion. And there's this very short-term focus with governments. And okay, they're going to get a chunk of change in the near term, but they will destroy their economy and the investability of that country in the medium and long term.
Perhaps not country risk, but the US will have a new president tomorrow. Donald Trump will be sworn in as the 47th president of the United States. And the recent weeks have seen quite a bit of news in the US in terms of permitting. Hudbay, well, let's start with Perpetua Resources got a record of decision for its stibnite, gold and antimony project in Idaho. Hudbay has got its permits for Copper World, and they've increased their stake in Arizona Sonoran, also in Arizona. Let's start with Hudbay. Hudbay wants a partner for Copper World. Rio Tinto is involved with Arizona Sonoran. So is there a potential partnership between Hudbay and Rio Tinto out there?
Absolutely. I think what you've seen is a bit of a sea change over the last 10 years where companies are willing to partner up, and particularly for very large capex builds. And part of that is there was a lot of failures at the top of the last cycle, and all of those CEOs lost their jobs. So you are spreading the risk to some degree. I do think with the change in government, and I would say soon to be President Trump's very, very public proclamations about increasing the investability in the states, I think it's very, very, very positive for mining. But again, the states is a bunch, the US is a bunch of individual states, and all of them have a different political risk profile. So I'd say the overall thematic is positive, but it's still very much location dependent. And then you have to follow the rule of law. And the risk in the US is once you get your permit, then you can be litigated into non-existence by NGOs and by environmental groups. I just want to touch on Perpetua a little bit.
Well, I'm going to get into that in a moment, yeah. So Donald Trump's made a lot of comments about, he's as annoyed as mining companies about the length of time in permitting, etc., and then, the 7 years of litigation that companies often tack onto their timelines to deal with that. To what extent or not can he actually do anything to address those or improve those?
The litigation aspect requires a change in tort law. Now, that's not going to happen quickly, but I think it behooves countries, not just the States, I would argue Canada and Australia and other countries as well, is you have these groups, or that you've created this ecosystem that allows them to grub up the system. And so I think that we need to step back, and you've seen whether it's Milei in Argentina that's fired a pretty material percentage of the government workforce. You have this bureaucracy that is unhelpful, that isn't a net positive impact to the economy or to the social structure. The power needs to be clawed back from those groups, because time is money. We live in a world that I think people will become more and more aware that resources are finite, that we need to have to maintain life as we know it. We need baseline commodity production, and that requires investment in that. And if you want to have security of supply in your own country, and the States has a number of very, very material critical minerals, it just has not been a place that you can develop those quickly. So I'm not sure how easy it will be for Trump to make any changes, but at least he's talking about it, in my opinion, in the right way.
Is one of the issues, Nicole, the sort of lack of transparency in the government processes? Because one of the companies we've mentioned today, I spoke with about this, and he said, look, from their experience, it's mid-level, lower-level government officials delaying things.
Absolutely.
They've got no skin in the game, they've got no incentive, they've got no rush to do things, and so files sit on desks and slowly move across them. Part of that perhaps is because there's no transparency of where the file is in the process and what's coming next and who's responsible for that.
I don't think that's just mining. I would say that's in every aspect of government, is how do you get the bureaucrats, how do you hold bureaucracy to account? I think that the additional struggle that you see in mining is a lot of these lower and mid-level bureaucrats, I think there's a certain ideological component that drives them to also not necessarily try and push things forward.
Welcome to Latin America.
They're not pro-mining.
Okay, cool. Let's get on to Perpetua. Stibnite record decision. They're looking at 400,000 ounce a year production of gold for sort of 20 years plus. I can't remember the figures, but a fair chunk of antimony or antimony as well. Thoughts?
It is a very rare asset. The duration, number one. The production profile. I can't think of another single asset company that's got 400,000 ounces for 20 years. It's in the US. I think the antimony aspect of it and the strategic nature of antimony and the US Department of Defense has materially reduced the risk of this going forward. I think that it will be a very, very attractive asset to a number of groups, and I would expect it to be a target of M&A.
Well, that's the question I've got here for you, Nicole. Who is going to buy them?
I think there would be a number of targets. Obviously, you've got any company that has a reasonable market cap and a balance sheet would be taking a seriously hard look at it. I think it's going to be a competitive process, frankly speaking. I think that many companies were stepping back and waiting to see how the permitting side of things would play out. And the element, the former CEO, Stephen Quinn, who I know very, very well, I mean, he took a very long-term view about the antimony and said this will ultimately become strategic. And I think we're seeing that theme play out. I don't know, name your company. I think there's probably at least 10 potential acquirers of Perpetua.
Well, that could be an interesting event this year. Before I want to talk a little bit about B2 Gold. With the cost overruns at Goose in Nunavut, many people viewed this as inevitable, and B2 Gold announced recently that it's halved its 4 cents per share quarterly dividend. That's now been cut to 2 cents per share, and it also announced a normal course issuer bid to start buying back its shares. Now, B2 Gold shares seem to have always underperformed in the market, even when things were going swimmingly for the company. So an NCIB makes a lot of sense. What is your view on B2 Gold? Did Clive Johnson overplay his hand with Goose? Was the goose in the hand better left off in the bush?
Look, it's a really tough asset. If that asset was in Nevada, it would have been developed 20 years ago. To me, what makes it so tough are elements that are beyond control, and that's climate. Because you have a very short summer season, you have a long winter season, you have to bring everything in the summer, in sea lifts, and then you have to transport it along an ice road in the winter. So if you have an unusually short summer period or an unusually warm winter period, that's to me where the risk lies. So you have to have this a huge amount of working capital that's tied up because you essentially have all your consumables, your fuel, your reagents, everything that you need for the mine, you have to buy it all at once for the year. So it's a really structurally high cost asset in terms of the working capital that's tied up. I think, to your point, I don't think it's a surprise that it's any new build anywhere in the world. We're still in an inflationary environment. You'd have costs escalating. It's much harder to control those costs if you are in Nunavut. Having said that, I think B2, with all of their other acquisitions, before the acquisition of Sabina, I would have put them up there as the best in the business. I mean, they did not put a foot wrong on M&A, and normally M&A is value destructive for the acquirer. And so they had done a very, very good job of building a company by identifying assets and materially improving them and building them very, very well. So maybe this was just a little bit outside their wheelhouse. There has been some change in some key personnel, some long-term people that worked with Clive that have retired. Any company that's building a big asset in that part of the world will be subject to pretty material risk.
Well, let's hope that things continue to go well there and it brings it into production and it does good things for the company. Now, you're familiar with the film Memento, the Guy Pearce film?
Yes.
Post-it notes everywhere?
Yes.
Okay. Capital raise Memento. And it's just unfortunate, I haven't picked out a company specifically for this. The company I've picked out is because they've just put a PFS out, so it's the most recent example. And that is West Red Lake Gold Mines. They announced the PFS for their Marsden Gold Mine project in the Red Lake district of Ontario, Canada, that envisions average annual production of 67,600 ounces per year over 6 years of full production within a 72 year mine life at an average all-in sustaining cost of $1,681 per ounce. The 800 tonne per day operation will generate an estimated after-tax net present value of 315 million Canadian at 5% discount rate and an internal rate of return of 255%, following a 44.1 million Canadian dollars initial capital investment. $2,200 gold price there. So far, so good. But what that doesn't include is that West Red Lake has spent more than 100 million Canadian to get there, and it's raised more than 180 million since it acquired Madsen in June 2023. That amount may not be reflected in the PSF calculations, but it certainly shows up in the capital structure, which has lifted the share count to 318 million from about 41 million in May 2023, a whopping 577% increase. Nicole, when you look at, I mean, it does amaze me that when companies put out economic studies, and everybody does this, not just singling out West Red Lake for this, the capital you spent to get to that point in time is forgotten. It exists, or it was raised, or what have you, and so the project economics never reflect on the money it takes to get.
Agree, it's crazy.
As an investor, I mean, how do you sort of take those things into account? You know it's going to come. How do you factor for that?
Well, number one, I'd say every failed mine has had a positive economic study, number one. I think when you, as an investor, if you were looking at the risk-reward proposition, a company, obviously it was an asset that failed due to a whole bunch of issues that we don't need to go into, and then a significant amount of capital has been deployed and it still requires more capital, and so the runway is lengthening. To me, there's risk in that. So I think that easy is better. So I would choose open pit over underground. I would choose, obviously, very simple gold processing over refractory. If I was looking at this company, I'd be very, very focused on the balance sheet. And so how quickly are they going through cash? And are you seeing the liabilities build up in a rapid way? So essentially, you're using your creditors as a source of financing for the company. I think there's still risk there.
Well, working capital was the aspect that undid the prior operator. They basically ran out of working capital. They couldn't develop enough phases quickly enough to keep the mill full.
And it was also, and this is the problem again with the translation of a resource estimate to an operating mine, and particularly in the context of an underground mine. Underground mines, by the nature of the beast, tend to be less continuous. They have a higher nugget effect. You can't have the density of drilling so that you will see in terms of grade control drilling that you can de-risk, for example, an open pit asset. And so it wasn't just working capital, I think, that negatively impacted the previous operators. Any single asset company, by the nature of the beast, they have a finite balance sheet. And so often what you see is an underinvestment on the front end of the capex, and you see that then reflected in OPEX and problems with operating. So I think that it wasn't just enough working phases. I think that the ore wasn't necessarily exactly where they thought it was, and the highly variable nature of the
detail.
Yes, yeah.
Well, I understand that the majority of that 100 million they've spent, that West Red Lake Gold has spent, has been on the drilling, in the infill drilling, to understand what the ore body is, where it is, how it is, etc.
I think it's got the Canadian cachet. It's got some industry, very famous industry people associated with that, understand the risk reward. For me, anything that's below 100,000 ounces a year also entails some risk. I think the 100,000 ounce mark it's kind of a magic number that you want to see, particularly as a single asset company.
Now, we're at the start of 2025. What are you looking forward to this year?
Oh, M&A. I think that there is going to be a thematic of M&A. I'm also looking forward to seeing investor interest, both corporate and investor interest, start to trickle down into the developers. And I think that's across multiple commodities in both the gold space and in the copper space. You have seen, unlike previous cycles, you haven't seen the developers move. And it's still very, circling back to the start of our conversation, it's still very, very, very difficult to raise money if you're an explorer developer, unless you have spectacular drill results. The drill plays will work in any kind of market, and it's easy to raise money. And I'd like to have a conversation one time about the irrationality of how we look at those companies. But the developers are super cheap right now.
Well, send me an email. Let's do that one at PDAC.
Okay.
Well, I'm wishing you all the best for this year. Nicole Adshead-Bell, thank you very much for joining us today.
Thank you very much, Paul.
And we have a lot more to come from the Vancouver Resource Investment Conference, so stay tuned on Kitco Mining, and don't forget to hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.